For years, many traders have been applying Fibonacci numbers to their charts to find retracement targets. That means when a market gets away from you like this, when Amazon suddenly dropped, where is it likely to come back to? What's a good entry level to continue that movement down since you missed the initial move? Rather than chasing this market, you wait for it to retrace and then you drop, get into the short position to take advantage of it. Of course, it works going the other direction as well. I thought a little background first. Leonardo Fibonacci was a 13th century mathematician. He noticed an interesting relationship between numbers. When you add, beginning actually at 0, if you add 0 and 1 together, you get 2. And if you add 1 and 2 together, you get 3, 3 and 2, 5, 5 and 3, 8, and so on. As you add these numbers up, this becomes the Fibonacci sequence of numbers. Where this gets extremely interesting is when you realize that there are ratios and relationships between these numbers that are constant even as the numbers get larger and larger and larger. The golden ratio, is if you take any number like 55 and divide it by 89, or 89 and divide it by 144, you will get 0.618 if you round to 3 digits. And again, this doesn't matter how large the sequence is. As the numbers get larger and larger, the ratio remains at 0.618. A second relationship is between a number and the number 2 places higher to it. So if you take 13 and divide it by 34, or 21 and divide it by 55, or 55 and divide it by 144, you will end up with 0.382. So those were the primary Fibonacci ratios that were used for years on charts to look for retracements. Since that works so well, people began to look for additional relationships that might have consequence to the charts. So the next one that was projected was, well, if it works for one number divided by 1 2 places higher, what if we took 13 and divided by 55, or 34 and divided by 144? And there you end up with a ratio of 0.236. Finally, since these ratios go from 2 below 50%, 1 above 50%, everybody was looking for one that was higher than 0.618 and still less than 1. I guess when the heart wants what the heart wants, and what we ended up with was if you take the square root of 0.618, you will end up with 0.8786. So those became the 4 ratios that everybody looks at on their charts. In between, most people noticed that 50% or 0.5 is just a common place that retracements have a tendency to go. I think that goes to the psychology of humans, that when we lose money or miss out on an opportunity and we get that shot at 50% recovery, we take it. So there it is. Those are the 5 main ratios. Most recently, people started to look for, well, since it works so well on looking for retracements, is there a way that we could use Fibonacci to predict where a market will go when it breaks out of a pattern? So when we've been expecting it to stay in this trend downward and suddenly it breaks to the upside, or we've been going to the upside and suddenly we break out to the downside. Could we project where the market will end up rather than just a question of retracements for our entries? So where do we get out of a position rather than just where do we get in? So the next thing that they came up with was that each of these numbers, and Fibonacci actually noticed this himself, each of these numbers happens to be 1.618 times greater than the previous number. So 144 is 1.618 greater than 89. So if we look at that as one potential for where a breakout might go. And the other one was, again, we want something maybe not quite so distant. Where would be another spot? They took the square root of 1.618 and we end up with 1.272. So these became now the commonly used ratios for both the Fibonacci retracements and the extensions. So let's apply this to this Amazon chart. Let's say we're watching this market, Amazon's gone up, it suddenly drops like this. And now we want to know, where is it likely to retrace to? So let's put in Fibonacci ratios where this is the significant high and this is the significant low. And you'll notice that the ratio up here, which the heavier ones are the 0.618 and 0.382 ratios. So we went up 61% from the bottom and almost exactly topped there before we started back down again. So this would have been the perfect entry price. All right, so now let's apply the extensions and see how they did in projecting or predicting where the market might go once you picked up that short position. Let's take a look at that. So we'll go back and we'll pick up the extensions. And so here they are. This is the 1.272 level, and this is the 1.618 level. So while we did exceed both of those, they were pretty good at projecting where the market would go to. And as once we hit that bottom and started back up again, they provided a level. You can see the market came back up to here before it went back down. So applying it to the Amazon chart worked beautifully. Let's take a look at a chart of Apple same way. I've already drawn the Fibonacci relationship in, but this was when the market went from 64, and that was actually pre-split, but 64 to almost $82, or right around $82 in a relatively short period of time. And so the market got away from us, and now we want to know, where would it likely retrace to for us to get an opportunity to buy into Apple. And now this is for historical relationship here. This is back in December of 2013. Now the market goes back down, and you'll notice that once again we come to the furthest of the Fibonacci relationships, and from there started back up again and bounced around in these numbers until we finally took off. Let's take now a look at the extensions and see what they tell us. And lo and behold, we have a relationship both here and here as potential exit points to the trade. And that's your lesson on Fibonacci for today.